Most of us buy a stock hoping that one day the price will go up. Pretty simple. But what if I told you that you could get paid just for holding a stock? And I'm not talking about some dividend that shows up every few months. I'm talking about cash in your account every single week. Today, we're going to explore a strategy that tries to turn a regular stock into a weekly income stream. Let's dive in.
Just think about that for a second. Instead of that little knot of anxiety you get when you check your stock's price, you could actually be looking forward to a weekly deposit. It completely flips the script, right? It changes your mindset from buy and hope to buy and earn. And that is the powerful idea we're going to unpack today.
So to really get our heads around this, we're going to look at a real-world example. It's an ETF from a company called Roundhill, and it's called the HOOD Weekly Pay ETF. You'll find it under the ticker symbol HOOW. And, as you might have guessed from the name, this whole thing is built around the performance of one very well-known stock, Robinhood.
So what is this HOW thing exactly? Well, it's an ETF, an exchange-traded fund, but it's got a big twist. It's actively managed, which basically means there's a team behind the scenes pulling levers to try and hit two big goals. First, generate those weekly cash payouts we've been talking about, and second, deliver enhanced returns. Think of it like a supercharged version of whatever Robinhood stock does that week. It's kind of part income machine and part short-term performance bet.
Okay, and this is where we really need to pump the brakes for a second, because this is super important. Investing in this HOO ETF is not the same thing as just buying shares of Robinhood stock. Sure, they're related, but they are built for two totally different reasons. So let's break down that difference. This chart really gets to the heart of it all. See, on one side, you've got regular old HOOD stock. You buy it, you hope the company does well, and the price goes up over the long run. Simple. But on the other side, HOOW is for a completely different kind of person. This isn't about where Robinhood's stock price might be in 5 years. No, this is all about generating cash this week. It's a strategy that puts immediate income way ahead of long-term growth. And here's where things get wild. 120%. The fund calls this enhanced exposure. What it means is they use some financial tools to aim for 1.2 times the weekly return of Robinhood. So if HOOD stock goes up 5% in a week, HOOD is designed to go up 6%. Sounds pretty great, right? But, and this is a huge but, it works both ways. If the stock drops 5%, the ETF is designed to fall 6%. It basically puts the weekly performance on steroids, which amplifies the wins, but it also amplifies the losses. And this just hammers home that critical point the fund managers want everyone to know. When you buy HOW, you are not buying Robinhood stock. You don't get a little piece of the company. What you own are shares in a fund that's using complex tools, like options, to basically create a synthetic bet that mimics and magnifies Robinhood's weekly moves. It's a massive difference in what's actually in your portfolio. Okay, so we know the goal is that weekly income, but how can you potentially turn that little stream of cash into some real growth? Well, that's where we get into this really powerful idea called the compounding loop. And this, right here, is the magic engine that could, potentially, drive some serious growth. It's a simple loop, but it's powerful. Step 1, you get your weekly payout. Step 2, you take that cash and immediately reinvest it, buying more shares of the ETF. Step 3, now you own more shares, right? So step 4, your next weekly payout is even bigger. You just keep repeating the cycle. It's that classic snowball effect, but because it happens on a weekly timeline, it could really put the power of compounding into overdrive. Now, we've talked about all the exciting stuff, all the potential rewards. But look, with any investment that's promising high yields and enhanced returns, you know there are going to be some major risks and costs involved. It is absolutely critical that you read the fine print. So let's walk through the most important warnings straight from the fund itself. I'm going to read this next part word for word because it is that important. It says, such conditions may not continue to exist, and there should be no expectation that this performance may be repeated in the future. You know what that is? It's the classic past performance does not guarantee future results, but in bold. It means those weekly payouts are not promised. They can shrink or they can disappear entirely, depending on what the market's doing. Next up, and this one's a doozy, we have to ask, where is this payout money actually coming from? Sometimes it's not from profits or earnings. Sometimes it's something called a return of capital. And all that means is the fund is literally giving you a piece of your own investment money back.
It feels like income, it looks like income, but it's really just a partial refund that's reducing your original stake in the fund.
And this is where it gets truly eye-opening. According to the fund's own documents about its most recent distribution, the payout was estimated to be 100% return of capital. Just let that sink in for a second. That means the entire paycheck that investors received wasn't profit, it wasn't a gain, it was just the fund handing them back their own money. That is a critical detail to understand.
And finally, let's talk about the price tag, because nothing's free, right? The expense ratio for this fund is 0.99% per year. That's the fee you pay for all that active management we talked about. Now, just under 1% might not sound like a lot, but to put it in perspective, you could buy a basic S&P 500 index fund for as little as 0.03%. So you are paying a huge premium for this weekly income strategy.
So let's tie this all together. What are the big takeaways? First, an ETF like HOWL is built for income now, not necessarily long-term growth later. Second, it's using leverage to shoot for 1.2 times the weekly move of Robinhood, and that sword cuts both ways. Third, and this is the big one, those payouts are not guaranteed, and they might just be a simple return of your own capital. And finally, all this complexity and potential reward comes with higher risks and, for sure, higher fees.
And all of that leaves us with the one big question. Is the allure of that weekly paycheck worth all the complexity, the amplified risk, and the extra costs that come with it? It's a fascinating trade-off, and honestly, understanding both sides of that coin is the only way you can start to make an informed decision for yourself. Thanks for digging into this with us.